All right, let's jump right into this wild reversal we're seeing in the bullion markets and unpack exactly what just killed the gold rally. If you've been watching the charts, and I know you have, you know the metals market has been an absolute roller coaster lately. Today, we're breaking down this sudden, dramatic drop in gold prices, and we're going to look straight at the data to figure out the exact forces at play here. Just to put the sheer scale of this market shift into perspective, we are looking at a massive 25% drop from gold's all-time high back in January. Think about that. On January 28th, gold peaked at a staggering $5,589. And now, it's retreated all the way down to a 6-week low of $4,150. That is a colossal move, guys. It marks a really abrupt, painful pause to a multi-year bull run that honestly, a lot of us thought was virtually unstoppable.
To make sense of all this chaos, here's our roadmap for today's explainer. We'll cover the fall of gold, 3 market triggers, technicals and central banks, emerging market impacts, and finally, the road ahead. Kicking things off with Section 1, the fall of gold, a massive reversal.
Seeing gold retreat to that $4,150 mark is definitely a major milestone, but here's the absolutely crucial point to take away. This sell-off, it wasn't driven by a single isolated event or just one bad headline. Nope. Instead, it was this incredibly rare, powerful convergence of completely distinct forces arriving at the exact same time. Basically, they systematically stripped away all the near-term support that gold usually relies on.
Which brings us to Section 2. 3 market triggers, a perfect storm.
So we're really looking at 3 totally independent catalysts here. First, a hawkish Federal Reserve pivot. Second, a major Goldman Sachs downgrade. And third, collapsed diplomacy in Geneva. When these 3 triggers essentially collided, boom, they pushed the US dollar to a 1-year high. And, well, you know the drill. When the dollar surges and treasury yields start climbing, capital gets pulled right away from non-yielding assets like bullion.
Let's look at that first trigger, a decidedly hawkish pivot from the Federal Reserve. Under Chair Kevin Warsh, we saw a very firm shift during his first FOMC meeting. Look at their June update. Officials actually raised their headline inflation outlook for 2026 up to 3.6%. Remember, that was just 2.7% back in March. Core inflation got bumped up too, to 3.3%. So now you've got 9 out of 19 policymakers expecting at least 1 rate hike later this year. By completely wiping out any easing bias, the Fed basically flashed a giant neon sign saying interest rates are staying higher for longer. And instantly, that makes holding zero-yield gold a whole lot less attractive. Then we have our second trigger, which was a massive institutional re-rating. Goldman Sachs significantly narrowed their conviction. They officially dropped their year-end gold price forecast from $5,400 all the way down to a new target of $4,900. I mean, that is a huge revision. Goldman had stubbornly held on to that $5,400 target through weeks of crazy geopolitical turbulence. So walking it back this sharply, it signals to the entire market that institutional faith in a near-term recovery is fading fast, at least until the broader inflation picture clears up. And finally, the third trigger. This one completely removed a major near-term diplomatic resolution catalyst. We got the news that the planned Geneva talks for the US-Iran interim peace agreement signing were flat out canceled. Switzerland announced the talks simply weren't happening. Now, normally, a canceled peace framework injects a ton of uncertainty into energy prices, right? But ironically, instead of sparking a flight to safety, this dynamic actually left gold out in the cold. It totally lost its traditional safe haven premium because the market was already so busy repricing those higher real yields. Moving on to Section 3, technicals and central banks. Let's look under the hood. You know, the 200-day moving average isn't just some random line on a chart. It's a massive trend filter for huge global funds. And gold just closed below this critical technical foundation for the very first time since October 2023. When an asset breaches a technical level like that, it actively, mathematically justifies institutional funds dumping their exposure. So this algorithmically compounded the aggressive selling pressure we were already seeing from all those macro triggers we just talked about. Greg Shearer, who's the head of base and precious metals over at JP Morgan, hit the nail on the head here. He noted that gold is currently stuck, in his words, in a bit of a technical no man's land. Basically, with growing fears that the Fed might actually have to respond to energy-driven inflation with real rate hikes, gold has simply been shoved to the back burner for most investors right now. But here's the thing. It's not just the investment funds hitting sell. The structural floor under gold has absolutely grumbled. Central banks, the guys who are the foundational drivers of this whole multi-year bull run, have completely shifted gears, away from accumulation. Check this out. In the first quarter, they sold a massive 129 tons of gold, and they only bought 16 tons. That is a staggering imbalance.
Breaking that down just a bit more, Turkey really led that Q1 selling spree. They offloaded a wild 60 tons in March alone. Now, yes, China has kept up some modest buying, but honestly, it just hasn't been anywhere near enough to overpower this massive wave of selling. This institutional outflow is the hard proof that the old environment of aggressive central bank accumulation, the exact environment that drove gold from $3,000 up to $5,589, has materially, undeniably shifted.
All right, Section 4, Emerging Markets Impacts, looking at the global ripple effects.
So what does this actually mean globally? Well, a surging one-year high US dollar paired with plummeting gold prices actively squeezes emerging market and commodity exporting economies, and it hits them in three distinct ways. First, it aggressively tightens their financial conditions. Second, it spikes the absolute cost of servicing their dollar-denominated debt. And third, it severely crushes their import purchasing power. We are watching a really painful macroeconomic squeeze play out in real time.
South Africa is pretty much the perfect textbook example of this double-edged sword right now. As a major gold producer, they're suddenly facing significantly lower rand-denominated revenues from their mining sector. But at the exact same time, because of that surging US dollar, their external financing burden is getting heavier by the day. They are stuck trying to manage a really complex fiscal consolidation path while basically getting punched from both sides of this market reversal.
Finally, Section 5, the road ahead. What's next?
Let's trace our timeline here. We started way up at the peak on January 28th at $5,589, right before hitting this dramatic reversal down to $4,150 on June 20th. So where do we go from here? Well, all eyes are currently glued to June 25th. The next major catalyst is entirely data-dependent. The whole market is essentially holding its breath, waiting for the Core PCE price index, which we know is the Fed's absolute favorite inflation gauge, alongside the Q1 GDP data. And guys, the stakes for this upcoming data release could not be higher. Sensing blood in the water, Citigroup has already slashed its 3-month gold target all the way down to $4,000. If that inflation data on June 25th prints above the Fed's 2% target, it's going to powerfully reinforce the case for even more monetary tightening. And that means we could easily see further downside, perfectly validating Citigroup's aggressive new forecast.
Which leaves us with one final absolutely critical question. Is that $4,150 support going to hold? As we sit back and wait for these data releases, we really have to wonder if this unprecedented convergence of hawkish forces, a tighter Fed, a surging dollar, institutional downgrades, and paused diplomacy, will finally be the hammer that smashes gold right below that psychological $4,000 threshold. The era of the unstoppable gold rally seems to have officially met its match. So the data over the next few days will dictate exactly how deep this reversal goes. Keep your eyes on the charts because it's going to be a wild ride.